There's been much discussion around a looming recession, with some claiming we're already in one. By economic definition, a recession means 2 consecutive quarters of decline in gross domestic product. In the US, the National Bureau of Economic Research defines a recession as a significant decline in economic activity that is spread across the economy and lasts more than a few months. The deciding indicators include GDP, payroll employment, personal income, spending, industrial production, and retail sales. But how will it actually impact our daily lives? And as an ordinary person, how can we better prepare ourselves for a recession? To better understand this economic phenomenon, we must look at the past and learn from it. The US has weathered 34 recessions since 1857, most notably the Great Depression from 1929 to 1938 and the Great Recession from 2007 to 2009. The Great Depression followed a period dubbed the Roaring Twenties. Stocks were in a clear bubble priced much higher than their actual value, to a point where it mismatched the economic status quo. Nervous investors eventually began selling off their shares en masse, leading to a stock market crash on October 24, 1929, known as Black Thursday. Millions of shares ended up worthless and Wall Street was immersed in a wave of panic. By 1933, about 15 million Americans were jobless, nearly half of the nation's banks had failed, and the market had plummeted as much as 90%. The 2008 financial crisis was sparked by the subprime mortgage crisis, leaving many financial institutions bankrupt and millions of American homeowners unable to pay their mortgage. The nation's GDP had its largest decline in 60 years. Unemployment reached double digits, and the stock market plunged roughly 50% in 18 months. What about this time? What's different about this recession? What are some repercussions to people's daily lives?
So yes, is the economy slowing down? It definitely is. But others would argue, well, the job market's so strong that we aren't really meeting the definition of recession. I would certainly put it that I think we're in a recession right now. Time will tell. Now, typically in the US, the average recession lasts about 11 to 12 months. And if that's the case, that would mean by the turn of next year, late December, early January, we should be starting to come out of a recession.
And obviously, the US has weathered many recessions in the past, such as the Great Depression, the financial crisis. So compared to the previous ones, what's the difference this time?
Sure. So we really have to put it in perspective of what happened with COVID-19 and all of the pandemic spending. What we saw was the federal government, being Congress and the Federal Reserve, put a lot of fiscal and monetary stimulus into the financial system and the economy. But we're talking, I believe it's in the neighborhood of $10 trillion. Now, we've never seen anything like this before. Something that people frequently look at is M2 money supply. It's a statistic kept by the Federal Reserve, and it's basically telling you how much liquidity there is out there. Or M2 is basically the most readily available funds for households. If you go back and look at a long-term chart, the explosion we saw higher in M2 money supply was basically never been seen before. In other words, a lot of people got a lot of money they never had before. So all of a sudden, that creates a lot of extra money in people's pockets. And all of that money being pumped into the financial system, it drops the value of the dollar. We're in a situation where all that extra money out there, it created demand for all types of goods. And then you throw on top of that the factor that people weren't traveling, weren't going into the office, weren't spending on gas, because they're not like flying on planes or going on vacations, they can start to buy things like iPhones, new cars, telephones. And all of a sudden, manufacturers cannot keep up with the demand they're seeing, and supply gets wiped out. So it's a bit of a long-winded answer for your question, but what's going on right now is we're seeing on a recession basis, it's relative to the hyper growth we saw last year. That has to slow down. But that slowdown doesn't mean it's going to be as dire or severe as what we've seen in the past. But it's not going to feel great because it's going to be worse than what we just experienced over the last year and change.
So I guess for many viewers, they may just concern about one thing, which is how will a recession impact their daily lives?
So one of the things that the Federal Reserve has been talking about is they need to get house prices down. So house prices or shelter prices are the single biggest component in the Bureau of Labor Statistics CPI, or Consumer Price Index, gauge of inflation. That accounts for 40%. So most people I know, a lot of their value in terms of their net worth is tied up in their house. And so one way it's really going to impact their lives is they're going to feel worth a lot less as they see their home values implode more or less or go down. So when you feel like you're worth less, you're not going to spend as much. You're going to hold on to more money because you don't feel as good about things. So one way it's really going to impact everybody's lives is they're going to start to see their net value shrink. And so they're going to be much more frugal with their money.
So I guess the final question is, in an environment like this, how can investors better protect their wealth?
Look for really good companies with strong balance sheets that have global brands that hold appeal through any type of environment. A name I would point people to is something like Hershey. Whether times are good or times are bad, you're going to eat chocolate. At least I know I will. I love chocolate. I'm sure others do as well. Think of healthcare names, companies that make pills like Advil that you need to use every day. Whether times are good or bad, you still need to go to the doctor. A company like that is, these types of companies are going to have steady cash flow coming in the door. And you want to sort of avoid companies with high risk and high debt loads. A lot of startup tech companies fall into that category. Those companies aren't going to pay dividends. So in this type of environment, you want to look for, good companies, fortress balance sheets, global brands, and they pay steady dividends because over the long term, that is going to reward you and grow your wealth.